As of the most recent trading session, which ended on Friday, November 21st, 2025, Moderna, Inc., trading under the ticker symbol MRNA on the Nasdaq, closed at exactly $23.72, marking a significant intraday surge of $1.36, or roughly 6.08%. It is important to note that the U.S. markets are currently closed, and this figure represents the final closing price from the last active session. While the broader market might look at this 6% jump as a simple technical bounce or a reaction to oversold conditions, the reality underneath the hood is far more complex and, frankly, far more interesting for anyone paying close attention to the biotech sector right now. The expectation for Moderna has long been that it is a company struggling to find its footing in a post-pandemic world, a one-hit wonder that is slowly bleeding out its cash reserves while chasing pipeline dreams that are years away from fruition. That is the narrative you will see on most mainstream financial news outlets and perhaps even on your investing sites. But the reality that just hit the wires, specifically revolving around their recent Analyst Day and a massive $1.5 billion financing deal, completely upends that bearish thesis. We are not just looking at a company trying to survive, we are looking at a company that has just aggressively cleared the decks, secured a massive war chest, and is betting the farm on a pivot that could redefine oncology. This isn't just a vaccine stock anymore. It is a high-stakes technology play in the biological space. And that 6% move is the market finally waking up to the fact that the bankruptcy thesis is off the table for the immediate future. When you look at a stock like Moderna, especially after the roller coaster of the last few years, it is easy to fall into the trap of recency bias, assuming that the downward trend is the only trend that matters. Most retail investors, perhaps those using a Robinhood app or managing their own funds through a Fidelity brokerage account, look at the chart and see a falling knife. They see a company that lost the massive revenue stream from COVID-19 vaccines and has not yet replaced it. That is the expectation, that the cash burn is too high and the pipeline is too uncertain. However, the reality we need to discuss today is centered on what happened just days ago. Moderna did not just announce earnings, they announced a complete strategic overhaul. They essentially took a scalpel to their own pipeline, cutting programs that were decent but not great, specifically the HSV and VZV programs, to focus entirely on the assets that have the potential to be blockbusters. This is the difference between a company flailing and a company executing a disciplined turnaround. They are targeting a 10% revenue growth in 2026 and have explicitly outlined a path to cash break-even by 2028. For a biotech company burning cash for R&D, putting a concrete date on break-even is a massive signal to confidence to the institutional investors. And speaking of institutions, that $1.5 billion loan from Eris Management is the curiosity loop that should keep you interested. Why would a company with billions on the balance sheet take out a loan? Because they are playing offense, not defense. They are ensuring that they have the runway to get their cancer vaccines across the finish line without diluting shareholders further at these depressed price levels. That is a move that savvy investors using Interactive Brokers or Schwab Intelligent Portfolios would recognize as a sign of management believing their stock is undervalued. Let's dig deeper into this price action, because a 6% move in a single day for a company of this size is not noise, it is signal. The volume we saw on Friday was robust, suggesting that this wasn't just short covering, but genuine accumulation. When you see a stock like Tesla stock or Nvidia stock make a move, it is often driven by momentum. But in biotech, a move like this is driven by data and balance sheet reassurance. The market was terrified of a cash crunch. The fear was that Moderna would have to issue new shares, diluting everyone holding the stock just to keep the lights on until 2028. The deal with Eris Management kills that fear. It provides non-dilutive capital, money that doesn't shrink your slice of the pie. This creates a floor under the stock price, which is likely what we're seeing technically on the charts right now. The traders who were shorting the stock, betting on a liquidity crisis, are now rushing for the exits because the liquidity crisis has been canceled. This tension between the insolvency fear and the capitalized reality is where the profit opportunity lies. If you're sitting there with your Fidelity Investments app open, watching the ticker, you have to ask yourself, has the market fully priced in the removal of this bankruptcy risk? The answer, judging by the fact that the stock is still hovering in the mid-20s, is likely no. The market takes time to digest complex financing, and many algorithms trading on platforms like Interactive Brokers stock trading systems might still be weighing the revenue declines heavier than the balance sheet stabilization. Now, let's talk about the actual business, because you cannot trade a ticker symbol without understanding the engine behind it. Moderna is not a pharmaceutical company in the traditional sense. It is a platform company. They built a technology, MRNA, that functions essentially like software for the human body. You inject a code, and the body cells produce the protein that fights the disease. We all know this from the COVID vaccine. But the expectation was that this tech was only good for infectious diseases. The reality is that Moderna is pivoting hard into oncology, cancer vaccines. This is the holy grail. They have a partnership with Merck, and they are deep into phase 3 trials for a personalized cancer vaccine, MRNA 4157 combined with Keytruda for melanoma. If this works, and the phase 2 data suggest it does, we are talking about a product that is not just a one-time shot during a pandemic, but a chronic, high-value treatment for cancer patients. This changes the valuation model entirely. Instead of jagged, unpredictable vaccine revenue, you start looking at recurring, high-margin oncology revenue. This is why they cut the other programs. They realized that trying to be everything to everyone was burning too much cash. By cutting the herpes and varicella programs, they are funneling all their resources into the programs that matter most: cancer, rare diseases, and respiratory combos. It's a classic shrink-to-grow strategy. For someone engaging in self-investing or using online investment tools, seeing a management team willing to kill their own darlings to save the company is a very positive indicator of discipline. Let's pause for a second on the macro environment, because no stock trades in a vacuum. We are in a high interest rate environment, although rates are stabilizing. For a growth company like Moderna, high rates are usually kryptonite because their future cash flows are discounted more heavily. However, the biotech sector has been beaten down so severely over the last 2 years that it's starting to look like a coiled spring. We're seeing sector rotation where money is moving out of the mega-cap tech names, maybe trimming some Apple stock or high-flying chip names, and looking for deep value in beaten-down sectors. Biotech is currently that sector. If you look at the flows in Fidelity ETFs or Fidelity mutual funds that focus on healthcare, you're starting to see a tick-up in inflows. This sector rotation is a powerful tailwind. Moderna, being a high beta name in the sector, tends to move faster and harder than its peers. When the sector rallies, Moderna rallies hard. Conversely, when the sector dumps, Moderna dumps hard. But with the recent strategic prioritization announcement, Moderna has arguably de-risked itself more than its peers. They have acknowledged the harsh reality of the post-COVID cliff and have adjusted their spending to match that. They slashed their 2025 R&D budget expectations, bringing costs down significantly. This demonstrates that they are listening to Wall Street. Wall Street told them, "Stop spending like a drunken sailor." And they responded, "Okay, we are cutting billions in planned spend." That alignment between management action and shareholder desire is critical. I want to hear from you guys on this point. Comment below how many shares of Moderna you currently hold, or if you are waiting for a specific price point to enter. Do you think the cancer vaccine will be the game changer they promise, or is it too far away to matter right now? Let me know in the comments. Continuing on the financials, the Q3 earnings report, which came out earlier in November, was actually a better-than-feared event, which often marks a bottom. Sure, revenue was down 45% year over year. That sounds terrible, but everyone knew it would be down because COVID revenue is vanishing. The key was the bottom line. They reported a net loss of $200 million, which was significantly lower than the massive losses analysts were projecting. They beat earnings expectations by a wide margin because their cost-cutting measures are kicking in faster than anticipated. When a company beats on the bottom line, despite falling revenue, it proves that they have strong operational leverage. They are becoming leaner. For those of you using SoFi Invest or checking your Robinhood investments, this is the metric to watch: cash burn. In previous quarters, the cash burn was terrifying. In this recent update, coupled with the Analyst Day news, the cash burn narrative has shifted to a managed decline towards a 2028 break-even. That is a massive psychological shift for the market. It changes the stock from a distressed asset to a turnaround play. Let's discuss the intelligent portfolio aspect of this. If you are using a service like Schwab Intelligent Portfolios, or even just managing a diversified basket of stocks,